Today, we are going to discuss two terms that are very commonly used in business, and these are bookkeeping and accounting. Many people use these two terms as if they mean exactly the same thing. Although bookkeeping and accounting are closely related, they are actually not the same thing. One of the simplest ways to understand the difference is to remember this statement. Bookkeeping records what happened, while accounting explains what happened and what it means. Every business, whether it is a small shop, a restaurant, a manufacturing company, or a large corporation, needs accurate financial information. The business needs to know how much money is coming in, how much money is going out, what customers owe, what the business owes to suppliers, whether the business is making a profit, and whether the business is financially healthy. This is where bookkeeping and accounting work together. Let us start by looking at bookkeeping. Bookkeeping is the process of systematically recording the financial transactions of a business. Every time something financially significant happens in a business, we normally have a transaction. For example, a customer may purchase goods for $500. The business may pay $200 for electricity. The business may purchase stock for $1,000. A customer may settle an outstanding invoice. The business may pay salaries to its employees. The business may purchase a vehicle, or the business may receive money from a bank loan. All of these are financial transactions, and the bookkeeper's responsibility is to make sure that these transactions are properly recorded and classified in the accounting system. So, if a business makes a sale of $2,000, the bookkeeper records that sale. If the business purchases inventory worth $800, the bookkeeper records the purchase. If money comes into the business, it needs to be recorded. If money goes out of the business, it also needs to be recorded. The bookkeeper also keeps track of customers who owe the business money. This is what we refer to as accounts receivable, or what is traditionally called debtors. For example, imagine that customer A owes the business $500, customer B owes $750, and customer C owes $250. The bookkeeper needs to keep accurate records of each of these customers and the amounts they owe. In this example, the total amount owed by customers would be $1,500. The bookkeeper also keeps track of amounts that the business owes to its suppliers. These are known as accounts payable, or traditionally, creditors. Another important responsibility of bookkeeping is bank reconciliation. Bank reconciliation involves comparing the transactions recorded in the accounting system with the transactions appearing on the bank statement. The purpose is to identify differences, errors, missing transactions, or transactions that may have been recorded by the bank but not yet entered into the accounting system. The bookkeeper also maintains the general ledger, where transactions are classified into different accounts. These might include sales, purchases, rent, salaries, electricity, bank, cash, debtors, creditors, and equipment. So, when we talk about bookkeeping, we are primarily talking about the accurate recording, classification, and maintenance of financial transactions. Now let us move on to accounting. Accounting is a much broader process. It involves recording, classifying, summarizing, analyzing, interpreting, and reporting financial information. Accounting takes the information produced through bookkeeping and turns that information into something that can be used to understand the financial position and performance of the business. An accountant does not simply want to know that a business made sales of $100,000. The accountant wants to know what those sales mean. Is the business making a profit? How much cash does the business have? How much does the business owe? How much do customers owe? Which expenses are increasing? Which products are profitable? Is the business financially healthy? Can the business afford to purchase another vehicle? And how much tax might be payable? These are accounting questions. So, you can see that accounting goes beyond simply recording transactions. Let us use an example to make this clearer. Imagine that we have a business called ABC Hardware. At the beginning of the month, ABC Hardware has $10,000 in the bank. During the month, the business makes sales of $25,000. It purchases stock worth $12,000. It pays $2,000 in rent, $3,000 in salaries, $500 for electricity, and $1,000 for transport. The bookkeeper's job is to make sure that every one of these transactions is properly recorded. The sales of $25,000 are recorded. The purchases of $12,000 are recorded. The rent, salaries, electricity, and transport expenses are also recorded. The bookkeeper's main concern is accuracy. Have the transactions been captured correctly? Have they been classified into the correct accounts? Have the customer balances been updated? Have the supplier balances been updated? Has the bank account been reconciled? Once the information has been properly recorded, we can then move into the accounting side. The accountant takes that financial information and uses it to prepare reports and analyze the business. For example, in our simplified example, the business has revenue of $25,000. The expenses total $18,500. That gives us a profit of $6,500. Now the accountant can begin asking deeper questions. The business generated $25,000 in revenue and made a profit of $6,500. But what caused that result? Are the purchasing costs too high? Are salaries reasonable? Is the business charging enough for its products? Are expenses increasing? Is the business generating enough cash? This is where accounting becomes particularly important. So, if we wanted to make the distinction very simple, we could say that bookkeeping is primarily concerned with recording financial information, while accounting is concerned with understanding and interpreting that information. Bookkeeping produces financial data. Accounting turns that financial data into useful financial information. There is another important way to understand this relationship. Imagine that you take your car to a mechanic. The car gives us certain information. We might know that the vehicle is traveling at 80 kilometers per hour. We might know how much fuel it has consumed. We might know how far it has traveled. The bookkeeper is similar to the person who records this information. But the accountant is more like the person who looks at the information and asks, "What does this tell us?" For example, the accountant might look at the figures and say, "Based on the distance traveled and the amount of fuel consumed, this vehicle is using more fuel than expected." The accountant is therefore interpreting the information. This is why we can say that bookkeeping produces financial data, while accounting turns financial data into useful financial information. Now, this brings us to financial statements. One of the major areas where accounting becomes particularly important is the preparation and interpretation of financial statements. There are three financial statements that are particularly important. The first is the income statement, sometimes referred to as the profit and loss statement. The income statement tells us how the business performed over a particular period. In simple terms, it helps us answer the question, did the business make a profit or a loss? For example, suppose a business has revenue of $100,000 and expenses of $75,000. The business would have a profit of $25,000. The second important financial statement is the balance sheet, also known as the statement of financial position. The balance sheet tells us about the financial position of the business at a particular point in time. It looks at three main things: assets, liabilities, and equity. Assets are things that the business owns or controls that have economic value. These could include cash, vehicles, buildings, inventory, equipment, and money owed by customers. Liabilities are amounts that the business owes to other parties. These could include bank loans, amounts owed to suppliers, and taxes payable. Equity represents the owner's interest in the business. And this brings us to one of the fundamental equations in accounting. Assets equal liabilities plus equity. The third important financial statement is the cash flow statement. The cash flow statement looks at the movement of cash through the business. It helps us answer the question, where did the cash come from and where did the cash go? This is particularly important because a business can actually be profitable and still experience cash flow problems. For example, a business may make many sales on credit. The business may therefore show a profit because the sales have been made, but if customers have not yet paid, the business may not actually have enough cash available to pay its suppliers, employees, or other expenses. This is why accounting is more than simply looking at sales and expenses. Now, let us talk about why bookkeeping is so important. Good accounting cannot exist without reliable underlying records. If the bookkeeping is inaccurate, the accounting will also be inaccurate. Imagine that a business actually made $50,000 in sales, but the bookkeeper only recorded $40,000. The accountant is now working with incorrect information. The accountant may prepare financial statements based on that $40,000 and reach conclusions that are also incorrect. This gives us an important principle that is often used in accounting and information systems: garbage in, garbage out. If inaccurate information goes into the accounting system, inaccurate information can come out. Therefore, good bookkeeping is the foundation of good accounting. But we also need to understand why accounting itself is important. Recording transactions does not necessarily tell the business owner what those transactions mean. Imagine that somebody tells you that their company generated $1 million in sales. At first, that sounds impressive, but is the business actually profitable? We don't know. We need to ask more questions. How much did it cost to generate that $1 million in sales? What is the gross profit? What is the net profit? How much money is tied up in inventory? How much do customers owe the business? How much does the business owe its suppliers? Is the business generating enough cash? Are expenses increasing? And is the business financially sustainable? These are accounting questions. This is why accounting is much more than simply entering transactions into a computer. A very simple way to remember the entire relationship between transactions, bookkeeping, accounting, and business decisions is to think about it as a four-stage process. First, a transaction happens. For example, a customer buys goods for $1,000. Second, the transaction is recorded through bookkeeping. The business records a sale of $1,000, and if the customer has not paid, the customer's account will show that the customer owes $1,000. Third, accounting takes place. The information is summarized and analyzed. We might discover that the business made $50,000 in sales during the month, generated $18,000 in gross profit, and ultimately made $7,500 in net profit. Finally, we reach the fourth stage, which is decision-making. Management can now use the information to make decisions. For example, management may discover that profit margins are declining. They may therefore decide to review their purchasing costs or reconsider their selling prices. So the entire process can be remembered as transaction, bookkeeping, accounting, and, finally, decision-making. Now, an important question is whether a bookkeeper is an accountant. The answer is not necessarily. A bookkeeper primarily specializes in maintaining accurate financial records. An accountant generally has broader responsibilities, which may include financial reporting, financial analysis, tax, budgeting, financial planning, management accounting, auditing, compliance, and business advice. However, there can be considerable overlap between the two professions. A qualified accountant may also perform bookkeeping, and an experienced bookkeeper may perform tasks that are traditionally associated with accounting. Therefore, the most important distinction is not necessarily the person's job title. It is the nature and level of the work being performed. There is also one more important point that we need to understand, and that is the role of modern accounting software. Accounting software has changed the traditional relationship between bookkeeping and accounting. Today, software can perform many bookkeeping functions automatically. For example, when a user creates an invoice, the accounting system may automatically record the sale, update the customer's account, calculate tax, update accounts receivable, post information to the general ledger, and produce reports. In other words, the software can perform many of the traditional bookkeeping functions automatically, but this does not mean that accounting knowledge is no longer necessary. Someone still needs to ask, are the accounts correct? Have the transactions been classified correctly? What do these numbers actually mean? And perhaps most importantly, what decisions should management make based on this information? That is where accounting knowledge becomes essential. So, as we come to the end of this lecture, let us return to the simple distinction we started with. Bookkeeping is the recording of financial transactions. Accounting is the process of using that financial information to prepare, analyze, interpret, and communicate the financial performance and financial position of a business. Or, if you want to remember it in the simplest possible way, bookkeeping tells us what happened. Accounting tells us what it means. And that is the fundamental difference between bookkeeping and accounting. Bookkeeping provides the foundation by creating accurate financial records, while accounting takes those records and turns them into meaningful information that a business can use to understand its performance, assess its financial position, and ultimately make better decisions.